Okay, good evening, everyone. Welcome to our CAPA Nova event. 欢迎大家来到我们 CAPA Nova 平台。Before we get into our seminar tonight, I just want to take 1 minute real quick, introduce CAPA Nova. CAPA Nova stands for Chinese American Parents Association of Northern Virginia. 中文是北威华裔家长协会. We are a non-profit organization. We started back in 2021, and over the past 4.5 years, we have provided more than 1,000 different topics for our community. So I am really proud to say this is perhaps by far the most active community group in the local area. And throughout the years, we have one major theme that is to introduce financial literacy to our community members. And this financial literacy series is a monthly based seminars, and tonight is our September session for this month. And again, Coach Mike, who is a very I think perhaps he is the most popular and most well-known speaker on our platform already. Coach Mike and also his best friend Steve is back on our platform one more time. And tonight they are going to bring us the topic on wealth building strategy by life insurance policy. All right. I know this is going to be really interesting because I know there's a lot of different products out there about whole life insurance and different ways and why it is a good strategy in terms of building wealth. And anyway, I am looking forward to hear their talk. I'm going to give the stage to Coach Mike. Coach is going to do a quick introduction about Steve. All right, Coach Mike, stage is yours.
Thank you so much. So I'm so honored to introduce my best Christian brother and also my mentor and inspire, Steve Parisi. He recently wrote a book. I shared the screen. You can get it from Amazon. Steve has been an entrepreneur for probably 10 years. He managed his own practice called IBC Global, and also he trained dozens of his own agents. Number two, he's an influencer. He has hundreds of YouTube videos, educational videos. Number three is he's very passionate about community service. He helps young people financial literacy class, and every year I invite him. And also, he's my personal banker. My family bank, I have at least 8 different policies through Steve Parisi. So I trust his knowledge, his ethics, and his dedication to his career. So with that, I'm going to introduce Steve, share how in this world we can build wealth, protect family, and perpetuate our family fortune. Steve, yours.
Hi, Mike. Thank you so much for the kind words. I do sincerely appreciate it. It is a mutual feeling, my brother, particularly with the number of our clients you've helped over the years, just with the tax planning, the family foundations, things I really don't know anything about and would be lost without you. So it is 100% a mutual feeling, I must say that. But thank you very, very much just for the kind words and for letting me come and talk about cash value life insurance this evening. We will have some fun. So everybody can see my screen? Good? Good to go? Perfect. So the topic this evening is building wealth with whole life insurance, both now and in the future. So I am going to cover a lot. It is going to be jam-packed in terms of information, and I'm going to share some examples and stories of clients that I've worked with for years. But before I just dive into the details, a few questions. First, has anyone ever tried to sell you whole life insurance before?
Yes.
Have you ever heard? Have you ever heard? Thank you. Have you ever heard that it's a bad place for your money? Or maybe that it's a scam?
Yes.
Have you ever heard that it's a great place for your money? Or that
Yes.
banks, corporations, and wealthy families have it? Question.
Yes and yes.
Thank you for that. I appreciate it. So, how do people use whole life insurance to build wealth now? Well, I'm not going to make you wait for the answer. The answer is through the cash value. Cash value is a safe place we can put money that I can access anytime, and it's also tax-free provided I follow IRS rules. Now, how do people use whole life insurance to build wealth in the future? The answer is the death benefit. When we pass, if we have a life insurance policy on us, the death benefit is paid out 100% income tax-free to our family or whoever our listed beneficiaries are. This provides an income tax-free windfall and can also be used as a tool to create a lasting legacy for future generations. I'll talk about that a little bit as we progress through everything. But what we'll cover is as follows. I'll talk about some of our clients who have been using whole life insurance as a wealth building tool for a long time. We'll talk about the cash value and the 3 core benefits: safety, liquidity, and the tax-free benefit. And then we'll talk about the importance of policy design, one of the most important things. Then we'll talk about how we can leave a legacy, particularly passing on generational wealth. And then we'll go through a fun case study. If you like the analytics and the details, we'll go through exactly how one can use a cash value life insurance policy to purchase real estate. So the goal of this evening's presentation is really to help you understand how cash value life insurance can help you build wealth safely, tax-free, and also leave generational wealth. Before we get into that, though, a little bit about me. So Mike did a very nice introduction. I hope mine is as good. So my name's Steve. If we haven't met, that is a picture of me and my lovely wife, Tara. In my free time, I like to teach about 40,000 people all about whole life insurance and a lot more. I am the founder and CEO of IBC Global. We currently serve a little bit more than 3,000 clients, many of which have 7-figure, 8-figure, and even 9-figure net worths. And one of our largest clients is a bank. And simply put, our mission as a company is to make the best life insurance and financial products and solutions available to everyone, not just those who have 7, 8, 9-figure net worths. I promise all of that is true. And if you'd like to have a conversation about life insurance, I'll keep it interesting. Now, before I started the company, I worked at what is called an executive benefits firm. And what my role was at that firm was really a back office guy. I got to design or model life insurance policies that were set up for maximum cash value for corporations that would purchase policies for their executives. And my job was to make sure that they had as much cash value as possible and that we didn't violate any IRS rules so they could access it tax-free. That's what they were interested in. But it was here where I learned specific details on how to maximize the cash value of a life insurance policy. I learned exactly why corporations put millions of dollars into these products. And here's a really important one: what life insurance companies to choose. After learning a lot about whole life insurance, I decided to go off and start my own company. And this is where it all started. So there's my ride to work. Took a 4-wheeler in a suit and tie. I'm kidding. I didn't do that. But that was my office. I actually still go in that door, as we still have that building. But if you came and visited today, you would not recognize it. It does not look like that anymore. We converted it in that particular location into a recording studio. And when I started, it was me and one part-time assistant. Now we're at about 30 employees strong. So, some client stories. All of these are examples of people that I've worked with for several years, and it's how they're using whole life insurance as a wealth building tool. First, we have Mazen and Rase. They're 2 doctors who own their own practice down in Naples, Florida. And what they are trying to do within the next several years is transition out of running their medical practice and into full-time real estate investing. So what they did several years ago is they each opened a policy where they fund up to $100,000 per year. Now the cash value grows safely, but they're actually using those policies by taking loans against the cash value for their business now, and then they plan to use this for their real estate later too. Next, we've got Tom. So Tom has a very large real estate portfolio valued at about $60 million. And the cash value in his policies, he treats as his business line of credit for property improvements and also new purchases. Earlier this year, he actually took $1 million loan from one of his policies. And here's the thing, which you're going to see in a little bit. He's still earning interest. His particular policy is right around 5% per year on that 1 million that he loaned against his policy. And he doesn't have to work with a bank, which he likes a lot. Next, we've got Max. So Max invests in commercial real estate, and he was at a point in his life where he was just tired of working with banks because he was told things like, we're going to cut your line of credit in half because the market has changed. He said, forget it. I'm not dealing with this anymore. I'll do it myself. So he took out some large policies that he's been funding for a long time. Whenever he requests a loan, he gets his money in 2 to 3 business days, and he doesn't have to deal with banks anymore either. Let's talk about the core benefits. So when it comes to building wealth now, that has to do with us using the cash value. In case you're new to whole life insurance, here's a high-level overview of the basics. Got different colors. We'll start with blue, the death benefit. The death benefit in a life insurance policy will gradually increase over time. And when we pass, the death benefit is paid out 100% income tax-free to our beneficiaries. Next, we have what is called our premium and PUA rider. We'll define these terms later, but both represent how we actually pay money into a life insurance policy. Now, with a whole life insurance policy, do you think you have to pay forever or your whole life? You don't. You'll see some examples in a little bit. And then we have the cash value, which goes nowhere but up over time. So this is the piece in green that everyone is attracted to. Why? There's a lot of reasons. Then we have what I like to call the 3 core benefits. If you have a whole life insurance policy and you look at the cash value, the first thing that you will have is safety. Specifically, your money is not invested in the stock market. You have guaranteed interest rates somewhere between 2 and 4.5%. These will vary depending on the company and product that you select. However, the net growth rate, after all of the insurance company's fees, expenses, everything that comes with the product itself, after the policy has been in force for a few years, it'll range somewhere between 4 to 5%, just conservatively. Next, it's liquid. You can access your money anytime you want, and your cash value keeps on compounding when you access it. And then third, here's the big one so many people are attracted to. If we follow IRS rules, we can access it tax-free. So who puts money here? A lot of banks do. If you look at Bank of America, they're the largest holder of cash value life insurance. They've got a little bit more than $24 billion in cash value. Corporations do. The 3 corporations on the screen, everyone likely recognizes these. Why I put these here, though, is because if you were to do a little bit of research, you would actually find that the founders, way back in the day, owned whole life insurance policies, and you could learn that they actually took loans against their policies to help keep their businesses afloat in the early days. They literally used their policies as a tool to build wealth, the wealth being their corporations. And then you'll see a lot of wealthy families leverage these products as well. So that's great in concept. Let's go over some of our actual clients. Earlier, I mentioned that one of our biggest clients is a bank. Here is the bank we work with. So in 2020, they made a deposit of $10 million. In 2021, another $10 million deposit, and in 2025, $5 million. So to date, they've deposited a total of $25 million, and their cash value has appreciated to close to $30 million. The death benefit is also massive, as that's a little bit more than $65 million. The death benefit, though, is not why they do it. When the owner asks about purchasing more bank-owned life insurance, what he is always focused on is the cash value and the fact that it grows safely, as they can position it as what is called a tier 1 asset on their balance sheet. That means very, very safe capital, and he really likes the tax benefits as well. Next, we've got a hedge fund officer who is one of the brightest individuals I've ever met, particularly when it comes to numbers and just his processing speed. So he's worked for some of the larger investment banks in the world, and he did research on whole life insurance. And here is his situation. He had about $5 million in a money market, earning between 4 to 5%, but it was taxable. He also lived in New York, earned more than $1 million per year, so he's paying a lot of income tax. So he was interested in a policy because of the safe growth and also the tax benefits, as long as we don't violate the IRS rules. So his specific plan, what we have up on the screen is exactly what he's doing, is funding a policy with a total of $2 million over 4 years, and he's taking money from his money market, the excess funds that he has in cash. His break-even point is year 4. That's the first year that the cash value exceeds his total payments. The annual yield represents his net growth rate on a year-to-year basis. The taxable equivalent in his 40% tax bracket represents what he would need to earn in a taxable account, and then after paying taxes, he would be left over with that tax-free yield that he has in the life insurance policy. So all that means is he would need to earn close to 9%, call it in a money market, and then at a 40% tax rate, after tax, he'd be left over with close to 5.4%. He looked at it and said, I'll just put in a life insurance policy because it peaks at about 5.4%, but I'm not going to mess it up from the IRS perspective, and there's not any risk there in terms of market fluctuation. I met him a little bit more than a year ago, and what he said was this: when I compare cash value life insurance with other fixed assets at some of the top hedge funds in the world, he mentioned Citadel, which specializes in fixed assets. He said that the net results are about the same, but the difference is that I don't have to pay any management fees, and there's no minimum buy-in with whole life insurance. And then he said it's a crime that more people don't understand this, which I liked hearing from him. Think we would have done this if this was a bad idea? No way. And then lastly, we've got Greg. So he invests in real estate. He is also an engineer, if I recall correctly. And I meet with him at least once or twice per year. He started his policy right around the time Tara and I got married. So what we've got up on the screen are his actual results. This is what his policy has done year over year. So he was initially interested in the policy for the safety, tax benefits, and then borrowing against the cash value for real estate. Now, at his stage in life, he's no longer paying into the policy. But what I want to highlight here is if we look at 2020 through 2022, he earned just under 5%, and that was no risk. Interest rates had bottomed out at that point in time, just with the low interest rate environment. This year, he'll do about 5.5%, which based on his cash value balance comes out to more than $56,000, also with the tax benefits that come with that. So people we work with are typically attracted to this product because it's a safe place for their money that they can access anytime and also has a nice tax benefit. All right, let's hit on a point that Mike had in his email, the importance of policy design. What not to do versus what to do. Have you ever been shown a whole life insurance policy and said to yourself, I don't get it. Like the numbers are just ugly. Why would anyone do this? A lot of people have. And the thing is, a whole life insurance policy can be a very, very bad place for your money, but it can also be a great place for your money. The key is just having awareness. It's important to know what not to do versus what to do. Because what happens too much in this industry is people get ripped off when they purchase whole life insurance policies and lose lots and lots of money. Here's often how it happens. You get a whole life insurance policy. You're told it's a great deal, that you're going to have a lot of cash value. But what's emphasized a lot is long term, long term, long term. But then you start to dig into the policy after you start it, and you see that there's not very much cash value to start. As you do more research, you find out you were sold a bad policy, and you're like, great, I got a bad deal. Here's a quick story about Doug the Doctor. This is a true story, and this happened very, very early on in my career. I just saw my boss and manager at the time sell this individual. He had read a book about how to use a life insurance policy as his own bank. After reading it, he wanted a whole life insurance policy, and he said to the owner of the firm, I want to put $100,000 per year into this policy, and cash value is my goal. Here's what he bought, or what he was sold. He paid $100,000 per year. His first year cash value was about $3,500. By the 10th year, he's paid $100K per year for 10 years. That's $1 million. It's not until year 11 that he finally gets his money back. If I sold him this policy today, I'd make $85,000 in the first year alone. That would be my commission. Doug was ripped off. Now, the thing about Doug's policy is about 92% of whole life insurance policies sold today are sold in that manner. Sometimes it's 100K, sometimes it's 10K, sometimes it's several million per year. But people just don't know. Here's what Doug didn't know. He could have had this. This is the exact same product with the exact same company. We're just setting it up differently. So what we've got here, same 100K out of pocket, but instead of $3,500 in first year cash value, it's about $88,000 in first year cash value. And instead of taking 11 years to get his money back, he gets his money back between 3 to 4 years. And for the agent, instead of making $85,000 in the first year, they'd make about $11,000, which I still think is a large amount. Like, that is perfectly fine. But if we look at the cash value, by year 15, he actually has more than $200,000 additional in cash value compared to the first option. And remember, what I just went through there were illustrations that I designed. I just put them on Excel, but they're with the same insurance company, the same insurance product, but just set up differently. This is referred to as the policy design. So, what do we have to look out for? Well, if we look at the bad policy, he paid $100,000, but 100% of his payment went toward these two words in red, the base premium. If you're taking notes, here's the important thing to be aware of. Money that I pay toward the base premium. As a consumer, I will see that it will prioritize my life insurance first and my cash value second. So because Doug paid all of his money, 100% of it, toward the base premium, he had a very low cash value as a result. That's the bad policy. With the good policy, only 10% of his payment went toward the premium. The other 90% went toward that PUA, which stands for Paid Up Additions Rider. I also like to call this a cash dump-in, and here's why. Money you pay here, you'll find will prioritize cash value first, and life insurance second. See what's going on? We're just balancing where the money goes. We're shrinking the premium, which shrinks the expenses, and putting more money toward cash value. Really, the lesson is that we want a good policy, one with a lot of cash value. Otherwise, we might feel like this. So, why do people often get a bad deal with whole life insurance? Why does that happen? Because what I just went through, any agent can set a policy up that way. Well, people usually just don't know. Consumers, people who are looking at the policy, they don't know where to start, they don't know what questions to ask, and they don't know what to look for. It doesn't help that the industry is literally incentivized to sell the opposite as well. So, if I'm you, I would just want to know what to look for. Here's what I would look for. First, make sure that a policy is set up for high cash value. This specifically means in the first year, I want to see between 80 and 90% of my payment available in cash value, and I'm breaking even between 3 to 5 years. Next, I'd want a flexible policy. What this means is that I'm only committed to the minimum. So in the good policy for Doug, he's committed just to $10,000, and then the other 90 is optional. He doesn't have to add it, but if he does, it can be at his discretion. And then third, choose a major mutual company. So this goes back to my days at the executive benefit planning firm. The one thing that always came up with major mutual companies is that they are the only ones who could consistently provide proof of performance, not just good-looking numbers on paper and then under-deliver. And here are your 4 major mutual companies. So to recap, the 3 things to look for: make sure the policy is set up for cash value, get a flexible policy, and choose a major mutual. Of our clients, those who follow these steps have a lot of cash value. All right, leaving a lasting legacy. Let's have some fun with this. Let's pretend that I'm your parent and you're my kid. If I have $1 million in a 401k and I die tomorrow, how much of that $1 million are you going to get? It's not going to be $1 million. I know most of you know this too. The reason why is because when you receive that $1 million, if it comes to you in a 401k, you have to pay income tax on it. Now, if I have $1 million in a life insurance policy and I die tomorrow, how much will you get? $1 million. The reason why is because with a life insurance policy, the death benefit is paid out 100% income tax free. Not estate tax free. If I have a high net worth, there's some other things that we need to do in terms of taking steps, but from an income tax standpoint, that is paid income tax free. So this is extremely valuable to a lot of people, especially those who are in high tax rates. Or if you're my child and you're going to be in a high tax rate, that's where that death benefit is particularly valuable. So a lot of times I'll see families leverage this product as a permission slip to spend other monies more freely, meaning they want to enjoy their retirement, but they also want to leave a lasting legacy. So a life insurance policy gives them a permission slip to spend other money more freely because they know the death benefit will be paid income tax free. It can also be used as a tool to pass generational wealth, and we can also follow the model that is used by wealthy families who do implement or who do have these policies. So how people typically use these products to leave generational wealth. Step 1, they'll start a life insurance policy. Step 2, the beneficiary is usually named a trust, and sometimes it's an LLC or a foundation or something different, but in most cases, it's usually a trust, and that's instead of a family member. Now, if I'm the insured, when I die, the trust is going to receive that money income tax free at my death. Now, the trust has rules written in it that state exactly how, excuse me, how and when the money can be used by family members. The trust can also state if some of that money should be used to open policies on children and grandchildren, which helps me compound the legacy that will be passed from generation to generation. It's a pretty cool strategy when you look at how people use life insurance in addition to other assets that are typically held within a trust. So, some examples of clients we've worked with. You might like this if you like charts and such. So first we've got Dave. That's not actually his name, but I changed it for confidentiality. So he set up a policy that's not directly owned under his name. His attorney set up a family LLC that owns the policy. The LLC is registered in the state of Delaware because the attorney feels that Delaware has favorable asset protection laws. The LLC, though, is part of Dave's trust. The trust is outside of the US. The reason why is because this provides additional layers of asset protection and ensures Dave's money is passed as efficiently as possible to the next generation. So here's what his situation looks like. You've got Dave and Maria at the top. Then you've got the main trust in red. It's over in Europe somewhere. And you've got a lot going on. And here's the life insurance piece. Another example. We've got Tina and Pat. They own a pharmaceutical business that generates significant income. Now they have a lot going on with their different locations and businesses. So you've got Tina, Pat, the owners up top, and then they have different life insurance policies. We see policy 1 is used for personal reasons. Number 2, business purpose. Another business policy, and then a personal policy. So with their life insurance policies, the cash value is being used heavily to grow the business. And they know if they grow the business, that will create generational wealth for both themselves and their employees. The business is what's driving everything. But then the death benefit is also used for key man insurance and also creating generational wealth, especially because it's paid out income tax free. All right, on to our last section. If you like numbers, you'll like this one. We're going to look at a case study of using a policy to purchase real estate. First, you like working with banks? Maybe, but it might also feel like this sometimes. So why a lot of people enjoy using their life insurance policy instead of working with a bank is often because it reduces a lot of stress. So let's compare the two side by side. Firstly, if I'm going to get a loan from a bank, there's a lot that goes into that. I've got an approval process. I might be denied. The loan amount is determined by the bank. I have to have credit. It affects my credit. The interest rate is set by the bank. There's possible closing costs and fees. I have to pay it back on their terms, and it takes forever to get approved. And I feel like this guy again. Versus a whole life insurance policy. There's no approval process. When I request a loan, I typically receive the funds in 2 to 3 business days. I cannot be denied. The maximum loan that I can take is always based on my cash value, and there's no impact or there's no credit check and no impact on my credit score. Both fixed and variable loan rates are available, and there's no fees or closing costs or payment plan requirements. Why people are often attracted to the idea of using life insurance to finance real estate is because they get their money fast, it's very convenient, and they're also in control. So here's how it works. I take a loan for my life insurance policy. But when I take a loan, I'm going to continue to earn dividends and interest on my full cash value. That includes the money that I've borrowed. So to simplify before I dive into the numbers, pretend you've got $1 million sitting in your bank account earning 5%. You pull out half of that. But the bank says, because we like you so much, we're still going to give you 5% as if you had $1 million there. I know that's a fantasy world. And banks also don't work like this. But life insurance does, meaning your money continues to compound even when you use it. So the insurance company does this by first reducing your death benefit by the amount you borrow. You're going to see this in 2 minutes. And then also charging you interest when you take a loan. So let's go through our case study. We're going to look at someone funding a policy not for their whole life, but only for 5 years. They're going to purchase a $300,000 investment property, and we'll review the net returns on the policy and also their real estate investment. First, we'll isolate the policy so we can understand how that works, and then we'll add real estate to the equation. So with the policy, here's what they're doing. They're funding $100K per year for 5 years. After that, they pay nothing. At age 50, which is year 6, their cash value is about $535. And then if we just let it sit and grow, at age 58, it's worth about $755,000. Okay, so that's what it looks like if I don't touch it. Here's the exact same policy, but what it looks like if I borrow against it. So we're going to take a $300,000 loan. If I'm you, and this is my policy, I would ask, how does that loan impact my policy? The cash value was $535. The cash value is my line of credit that determines how much I can borrow. I see that line drop. It's just about $220,000. My death benefit also drops. It was 1.8, now it's 1.5 million. When it comes to paying back loans, we can pay loans back however and whenever we want. In this example, we're going to pay it back at $50,000 per year. And we usually like to break down how much of our payment goes toward principal, how much goes toward interest, and then I see the loan balance coming down over time. What's my money look like after the loan is paid? Here we go. Here's an easier view. In both scenarios, the cash value is worth $755 and the death benefit's worth 1.8. So what this means is you took a $300,000 loan against your policy, but your full cash value, that 300K included, kept compounding even though you used it for something else. So you can use the cash value to go out and purchase real estate in this example, while it continues to compound between 4 to 5% per year. This is typically how people will use life insurance to buy real estate. They know that they're earning a return on their policy. They then use that money to go out and earn a return on their real estate, sometimes express, I feel like I'm earning 2 rates of return on $1, and they don't have to deal with a bank. Sound good? What's the catch? There's always a catch, right? There is. Knowing your numbers is important. Here's what I like to look at that helps a lot of people just see the pros and cons. What's my cash value growth? Specifically, what is the insurance company paying me in interest? What's my cost to borrow? What am I paying them in interest, specifically loan interest? And then also factor in your real estate investment. So an easy way to look at the numbers is to simply look at how much I'm getting from the insurance company, how much I'm paying the insurance company, and then how much income I'm receiving from my real estate. First, what is the insurance company paying me? This is your cash value growth. If we look at year 1, you paid $100,000. Your cash value was $92,000. It's about a $7,700 loss in this example. This, by the way, the loss up front, that's the drawback that is often brushed over or a lot of folks try to hide. We do want to isolate the drawbacks or see them so we know what they are. If we go to year 10, cash value, 636. I pay 0, grows to 663. That is $27,000 in change in earnings that year. So the cash value growth is how much my money grew by over the course of 1 year. Loan interest next. This one's pretty simple. I took a $300,000 loan. The next year, I paid loan interest of $16,680. Real estate return. I purchased a $300,000 property. The annual return in this example is 10%, which would produce annual income of $30,000. We're making it super simple. So that's my return on my real estate. Here's how we get to the net of everything. Starting with the policy, I'll look at my cash value growth and subtract my loan interest. So if I look at year 7, when the loan interest was the highest, my cash value growth was $23,886. What I paid in interest, $16,680. What's the spread? About $7,200. I'm cash positive, meaning the insurance company paid me more than what I paid them in loan interest. Now we've got to add the real estate return. So to do this, we're taking our whole life insurance policy, getting a loan, purchasing the real estate, which in this example is producing 10% or $30K per year, and factoring that into the equation. There's our real estate return. So if we add the net policy earnings of $7,200 plus the $30,000 from the real estate, there you go. Total return, $37,206. And in year 7, the loan interest was the highest. If we go down to the bottom of the chart, when the loan's paid off, what do you notice? Cash value growth, $33,000 and change. Real estate return, $30K. Add the two together, we're at $63,000 and change. This is something we put together for clients and walk through the numbers with them too, in case you're looking at this and saying, this is a lot. So we're on the home stretch. How it works, you earn interest on your entire cash value. You pay interest only on the loan balance, while at the same time, we're earning a return on our real estate. The lesson is that our money keeps on compounding even though you borrow against it. To recap, here's what folks do. They've got their life insurance policy, take a loan against it, purchase property, or sometimes invest in their business, take the returns from the property in this example, and use that to repay the loan. The whole time, they're earning 5% in the policy and earning a return on their real estate investment, all with the same dollar. So this is typically how we'll see individuals use whole life insurance as a wealth building tool while they are alive. So in summary, people use whole life insurance because it's a safe place to put money, easy to access, and it's also tax-free if we follow IRS rules. So let me ask a few questions. Now that you've learned everything there is to know about whole life insurance, no, not really, but a lot, and how you could use it as a wealth building tool, do you see how the cash value can help grow your money safely and how the death benefit is paid income tax-free? Do you see how you could leave a tax-free legacy through the death benefit, and also what not to do versus what to do when it comes to the policy design? And then do you also see how you could leverage a policy for opportunities like real estate? So from here, I've got two choices. One, you need more information. Two, you're excited to implement. What I'm going to show you will provide the answer to both of these paths. So for more information, we've got a lot of resources. We've got our website, ibcglobalinc.com. We've got our YouTube channel, which you can just punch in IBC Global or Steve Parisi. And then we also have a lot of resources. We have guides that we've created over the years. And then we also have my book, which Mike showcased in the beginning. So here is a sample of some of our guides. You can find these on our website. The one to the right there is popular, using a whole life insurance policy to pay off your mortgage. We'll typically show one what things look like if they just keep paying down their mortgage as is versus using a life insurance policy instead. And then we'll break down the actual interest expense and see which one makes more sense when we actually look at the numbers. Learning from wealthy clients of ours, and then some additional guides. The quick start guide is nice if you just really want to understand the facts about whole life insurance and how the cash value works. On our website, we've got this old, ugly picture of me that I'm not a fan of. But right on the home page, you'll see you can access our Knowledge Vault, and that will give you access to our guides. And then if you scroll down in our Knowledge Vault as well, you'll see our advanced training, which provides video courses. And if you did want to book a strategy session, that'll actually book a meeting on my calendar. If it's a bit out in terms of available time slots, we can certainly reach out to you and arrange something sooner, whether it's with me or one of my associates as well. And then we've also got my book there, which, Mike, I can send this to you along with the discount codes if you'd like.
I paid full price.
Thank you.
Send
I
it
can
to
send
me,
you
Steve.
the discount. And then there's my personal contact info. That is my cell. If you do call or text, like texting works fine. Just shoot me a text, like include Mike Nee on it, or just CAPA Nova. This way I know exactly who I'm getting the message from, and I'll put it together because I don't always give my cell out, but I trust Mike more than I trust most people. Talked a lot. I'll stop there and we can open the floor to questions if you'd like.
Well, there are a lot of
Steve,
questions. Yeah.
Steve, take a look at the chat box. There are a lot of questions posted for you.
Absolutely. Thank you, everyone, for your questions and for sitting through my long presentation. I hope it was valuable. All right, let's take a look here. So, thank you for posting the YouTube channel and the book. Thank you very much. Please share the PowerPoint access so I can forward it to my partner. I can send a copy. Mike, would it be best if I just send you a copy of that PowerPoint? Yeah, I'll email it to you direct.
So the CAPA members, they can access for free. If you're not a member, talk to Yuan, you can register with us. Yeah.
Absolutely.
Good idea. Yeah, so I don't know, the person who asked for the PPT, make sure you're a CAPA Nova member.
Got it.
All right, let's keep going. Next question.
Yep. So how many years do we need to fund the whole life insurance policy? Why don't we need to pay forever? Are we using death benefits to pay for premiums in the future? Are the table guaranteed numbers or are the tables guaranteed numbers or projected numbers? Very, very good questions. So the first question, how many years do we need to fund the whole life insurance policy? So this is 100% dependent on the design of the policy. Remember the bad example that Doug had where all of his money went toward the base premium? If someone purchases a policy where everything goes toward premium and their cash value is zero right out of the gates, they're going to have to pay for a minimum of often 7 to 10 years, sometimes longer. On the flip side, if the policy is designed where they're putting $1 in or any dollar amount, but the premium piece is minimized as low as the insurance company will allow, with those 4 major mutuals, the minimum is often about 10%. So for example, Doug was paying $100K per year. His base premium was $10,000. The other 90 went toward PUAs. In a case like that, you could pay into it for 1 or 2 years very easily and then never pay into it again. That's based both on the guaranteed and non-guaranteed values. We do have some case studies that demonstrate that exactly. But really what we're doing there, if we're stuffing the cash value, we're putting ourselves in a position where dividends and interest begins to accrue in that cash value immediately, and it can easily satisfy the policy. Now, your next question is, are we using the death benefits to pay for the premiums in the future? So not necessarily. You will see the death benefit go down in some cases when we do use dividends and interest to pay the premium. It depends if the dividend is higher than the base premium, but I can certainly send you some info, or our YouTube channel does provide some very specific case studies on that. But we're not necessarily using the death benefit. The cash value and the interest earned is what's producing that. And then the tables that you did see in the presentation were all based on the current dividend interest rates with the insurance companies, not the guarantees, although that is something that we always will show in full disclosure to prospects and clients. But one thing on that, actually, always beneficial to look at the guarantees. A lot of times those are almost hidden or just brushed aside or brushed over in conversation. What I'll also add is, is if a policy is designed properly and placed with one of those 4 major mutuals, looking at the non-guaranteed values, I think is okay to do, because we do track the actual performance of policies. And I see those 4 major mutuals deliver very close to the non-guaranteed results, in many cases spot on, as long as they're designed appropriately. All right, good question. Another one. What factors decide that I'm breaking even in 3 to 5 years? Shouldn't we always want to break even earlier? The earlier the better. So the biggest factor that will decide the break-even point is the ratio of where your money is going between the base premium and PUA rider. Just knowing the rules of the game. So those 4 major mutuals will often allow you to have a 10% minimum premium. So for an individual who says, I want to pay a maximum of $10,000 per year, we'd set his or her minimum commitment at $1,000 per year. For Doug, paying up to $100K per year, we'd set his minimum premium at $10,000. And then for the example of Dave, I didn't show the policy, he does up to $1 million per year. His minimum's at about $100,000. It's all ratios. If we push the premium as low as the insurance company will allow and stuff that paid up additions rider, particularly for the first 2 years, you'll see that break even in most cases between 3 to 5 years. And yes, we always want the break even earlier. The earlier the better. That is true, as it gives you more cash value short term and long term. Question from Fred here. Why wouldn't someone just buy a term life insurance policy and invest the additional amount and borrow on the margin if money is needed, potentially earning 10% per year in the S&P 500? So really good question. A lot of our clients do that in addition to owning a whole life insurance policy. Why they'll often have a life insurance policy as well is because they view it as a portion of their fixed portfolio, and it's just very easy to access. It's not tied to the market or anything of that nature. So it's typically 2 separate buckets in that respect. But really good question there. Next question. If the policy owner passes, the heir can only get the death benefit. All the accumulated cash value will be forfeited. Is this true? So good question. I will say yes and no. Why I say yes is because when I die, whatever the death benefit is on paper, that is the only dollar amount paid to my beneficiaries. However, the death benefit always accounts for the cash value. So what you'll see, particularly with a high cash value whole life insurance policy, is as your cash value grows, your death benefit grows with it, and it's always higher than the cash value. So the net death benefit also accounts for that cash value when I die. But on paper, the death benefit's what's paid out. So a lot of times people look at that and say, that's what's paid out, which I get. Next question. If I take a loan against my whole life insurance policy, I would need to pay back the interest to the insurance company, right? Why would people say be your own bank? Very good question. So you're actually not always required to repay the loan interest. In fact, you'll see a lot of individuals take loans against life insurance policies in retirement Why they're doing that is because loans are a great way to take money out and it's tax-free. In retirement, they're not making any interest payments or any loan principal payments at all. Now, we do want to make sure that we don't pull too much money out and it lapses. That's really the agent's responsibility, and that does result in the death benefit being significantly reduced when we pass. But I say all of that just to illustrate the fact that we are not required to repay policy loans. It often makes sense during our working years, but we usually like to show what does it look like if I pay it back versus not paying anything back at all. Will your book be on Kindle as well? Yes, we're hoping to have it on Kindle within the next month or two, and we should have an audio book in the near future as well when I get to sit down and actually record it. Next question. Please compare whole life versus IUL. IUL has long-term care. Whole life does not have that option. Really good question. So whole life actually can have that option. I'm assuming you're referring to a living benefits rider. So a lot of whole life insurance policies do. I know a lot of folks in the IUL marketplace will say IULs offer it, whole life does not. Some whole life products don't, but many do. So a lot of times that can be attached. It's often a free rider, just like what you'll see in an IUL. And when you look at both whole life and IUL, they are both cash value life insurance products. The difference between the two is that an IUL offers a lot more upside. Your money is linked to an index. In most cases, it's the S&P 500. And how it works is that the market goes up, you go up with it. The market goes down, your principal is protected. We don't use IULs a whole lot. The main reason why is very similar to why we don't use other whole life insurance companies outside of those four major mutuals. It just comes down to the proof of performance. I do like to see proof that a product and company has delivered before I recommend it just based on what I see on an illustration. And I've seen it with whole life with the four major mutuals. I have not seen that over a long duration with IUL products with any company yet. So that's the main reason we do tend to lean toward whole life. I'm not opposed to IULs. I just do need to see the proof before I recommend someone put money into the product. IUL cash loan also has no interest. So you will see loan interest with IUL products. Sometimes it's sold as a wash, where an agent might say the interest you're earning will at least wash out the interest that is being accrued on loans, but there is still interest that's accruing there. So there's typically always loan interest with loans, whether it's IULs or whole life. I would definitely look into that in detail. But very, very good question. Thanks for buying the book. I appreciate it. The discount code, what I'll do, Mike, I can email you those if you'd like. Does this strategy apply to IUL as well? So in concept, yes, you can use it. You do have some added risk there though, which I can certainly send some follow-up material on whole life and IULs. I do have some drawbacks with that, or just areas of caution before I would just dive into that. Ooh, which insurance company has the best whole life insurance policy? Well, if you were to go talk to agents from different life insurance companies, they would all tell you they're the best. With that said, here's what I would say. I would always look at the four major mutuals: Mass Mutual, Guardian, New York Life, and Northwestern Mutual, regardless of who you work with. The simple reason why is they can provide proof of performance. And we do have proof of performance on our YouTube channel. I did include several case studies in my book as well, documented policies where you can see policies that have lived the test of time. But I like those four major mutuals because a big problem in the life insurance industry is overpromise, underdeliver, meaning things look great in paper, then it underdelivers, people get upset. I've seen that not happen when we follow the corporate model, which is a minimum expense policy or minimum premium policy with the four major mutuals. And then, what if something happens in a year or two, or my business doesn't do as well as last year? Am I obligated to make the same premium payments? Excellent question. So no, you can set a policy up to be extremely flexible. So if we take that real estate investor, for instance, who is funding $100,000 per year, what most people we work with do, who have a policy where they can fund up to 100K per year, for example, is we set it up where they are only billed for $10,000 per year, or 10% of their target amount. So now they're billed for 10K, and everything above that 10K, up to a total of 100, they can add to their policy at their discretion by logging onto their online account, their mobile app, and just throwing money into PUAs via ACH transfer. Whether they hit 100 or not is totally up to them. But what we're doing there is taking an old life insurance product that can be boring and turning into a flexible savings asset. The fun part of cash value life insurance. You can tell I'm nerdy with stuff. All right, another question. Do you recommend that we use a third-party bank to borrow against our life insurance policy, or just get it directly from a life insurance or from the life insurance company? So that's a good question. Where interest rates are right now, it is more favorable to go directly to the insurance company. Several years ago, it was more favorable to go to a bank. If I'm doing it for business, there are some added benefits to using a third-party line of credit. It's just easier from a tax standpoint, as you can check off the loan is for business purposes. If it is for business purposes, to be compliant, that is. But that can be a bit easier. There's pros and cons to both. Typically, we like to look at both, and it is something you can pivot as the years pass. So I don't have to feel as if it's all or nothing or something like that. And the last question I see here, there are a lot of groups out there trying to recruit agents. What are your thoughts on that? Good question. So I fell into that before when I was always recruited. I would not jump in to the first group that you talk to. Typically, when finance groups are attempting to recruit people, that is the way to grow an agency. It's the way. So for example, if I'm recruiting people and I recruit 100 individuals and each of those 100 people bring me 3 to 5 new clients, I just have what? 300 to 500 new clients. That's how companies often grow their business. But then about 9 to 90 to 92% of agents fail, meaning they fail out of the business. So now all of those clients that were brought to me, most of the agents aren't in the business. I, the agency, keep all of those clients, and I also have the relationship now, which can be awkward for the person who brought that business to some other person that they don't really know that well. And the big problem is what I went through in that presentation. It can be a lot of material, like what to do versus what not to do. What happens a lot when people are recruited by agencies is they are encouraged or they don't know, but they're selling policies that are the bad version, meaning they're low in cash value, they're very high in commission, and then they fail out of the business. And then later their family finds out or they learn, hey, this policy was not set up in my family member's best interest. And it's just difficult because we're new. We don't know what we're doing. We're trying to learn. We're trusting our managers and such. Not all finance groups are like that, but just in my experience, many are. So it just takes some discernment and just taking your time as you're looking at different options. And a lot of times it just involves speaking to someone who might have experience or just approaching the situation in a sense to say, hey, if I was giving advice to my friend, here's what I might recommend before just diving in. Hope that makes sense. The big four major mutual companies, what premium financing companies do they allow? So I've actually got a list for that with MassMutual and Guardian that I can certainly provide if you'd like. But there's a lot of lenders that they will use for premium financing. And even when I speak to MassMutual and Guardian, like they're always open to vendors and banks that are not on their list. For example, the bank that we work with, I've talked to MassMutual and Guardian before about using that bank for premium financing cases, and they're like, yeah, we'd be open to it. We would just need to approve it, see what the terms are and such, because they want to protect themselves as well. But in most cases, you'll see that they are open to everyone on that list and others. But very good question. Thanks for all the questions.
Yeah, that was great. Hey, Steve, do you mind put on the slide for your contact information again? Because there are several participants are asking for your
Yeah.
contact information.
Mhm.
And as what Steve said, we will share the book discount code, and any audience wants to have Steve's PPT, you can either reach out to me or to Coach Mike to get a copy. And if you have any further questions and want to follow up with Steve, and here is his contact information. And Steve, thank you so much. And I know we have already passed our time, but this is really, really fun. And I never heard anybody else talking about whole life insurance this, in this humor way and this interesting way. And so really appreciate all the informations. All right, Coach Mike, do you have a closing statement?
No, I think we are learning every time from Steve.
Exactly. Yeah.
He's the knowledge reservoir. Every time I learn from him, I feel, wow, why nobody told me this?
Oh,
Yeah, I do have some clients, tax clients said, I bought this 10 years ago, New York Life. This
yeah.
still compounding, not break even 10 years. So what can I do? So probably you have to take over, no, not take over. There are some what they call the buyer's remorse. You have to, we have to deal with that because people don't know they get into this. Yeah,
Mhm.
happens before all the time.
It does. I fell into it when I was new. Like it's just there's a lot to it.
Yeah. I really like the
Yeah.
example doctors purchase real estate. I think as a tax professional, the best strategy is using the life insurance called the iBlock life insurance line credit to buy rentals. Why? The husband's doctor, the wife is real estate professional because when you buy 5, 6 rentals using life insurance loan, you can change your status to a real estate professional as a spouse. Then given the Trump's the one big beautiful bill, you can do cost aggregations, you can do bonus depreciations, you can create a lot of losses. The loss can offset the doctor's salary because
Yeah.
that's the best deal. You use the life insurance to treat. That's the best strategy. And also
Yeah.
one thing that Steve, I want to add on is when you borrow a loan from life insurance to purchase business property like real estate, the interest loans or business in purpose can be deductible on Schedule E. So that's the one
Mhm.
thing I always tell the clients, do not leave money on the table. IRS allow because the money borrowed from all the policies used for business producing properties, they are deductible.
Look at that.
Yeah.
Yeah. With a tax-free benefit, which is
Absolutely.
nice.
Can you
Yeah.
imagine you get benefits left or right?
Yeah. It's a win-win.
Exactly. So, anyway, we're gonna have to close for tonight, but before we close, I just want to give everybody a quick advertise for tomorrow's event. We will have Albert Joe, who is a lawyer, and he is going to discuss about wealth building as well, and it is going to be specifically focused on 遗产信托的规划. So it's going to be in Chinese. So for the audience, please join us tomorrow, and we will continue to learn and protect our wealth and pass on the legacy. All right. We're going to close tonight. Thank you, Steve. As always, you see how popular you are with our audience, and thank you for taking the time and giving us this seminar. It was really appreciated. Thank you.
Yeah. Thank you so much. No, I appreciate you guys always inviting me, and thank you very, very much. If there's anything you need from me or anything I can do, just let me know. I appreciate
All
it.
right. Yeah.
Amen.
Thank you, Steve. Thank you, Mike. Good night, everyone.
Good
See you
night. Thank you,
tomorrow.
guys.